Are you in the market to purchase a home, but you have several questions when it comes to financing? Do you ever wish you could sit down with a loan officer and just ask them tons of questions and they could answer you? Well, today we have Natalie.Resendiz with us, a mortgage officer with several years of experience to answer the most common questions buyers have. Now, don't forget to stay to the end of the video because she's going to show you how to obtain $7,500 completely free towards the purchase of your home. What documents do I need to apply for a home loan?
The documents that we will need to get you pre-approved include your ID, income documents such as W-2s and pay stubs. If you're self-employed, we will need your last 2 years tax returns and your most recent bank statement to verify your assets. Those are the most basic documents that we need for a pre-approval. In addition, if you receive additional types of income such as child support, Social Security, disability, retirement, we can also use those incomes to qualify you, but it will require additional documentation. A lot of clients will ask, how much can I borrow for my home purchase? This will vary greatly depending on your credit score, your income, and your liabilities. I can have a client that makes exactly the same amount of money, but the amount that they qualify for will be different based on their credit score and the liabilities that they have.
What is the difference between pre-qualified and pre-approved?
The difference between a pre-qualification and a pre-approval is that with a pre-qualification, you're submitting an application with the information that you know about yourself. With a pre-approval, you're actually submitting documents so that we can verify the information that you have provided to us. This is very important because with a pre-qualification, you can tell us that you work 40 hours a week, but once we receive your pay stubs, this may not be accurate and this can change the loan amount that you qualify for. So it is very important that you submit documents and get a true pre-approval from your lender.
Why do I need a pre-approval letter?
It is very important that you provide documents so that the lender can provide you with a pre-approval letter because agents will not show you any homes or make any offers on properties until you have a pre-approval letter from a lender.
Hey, if you're finding value in this content, please do me a favor and please hit that like button down below. And don't forget to subscribe so you can keep receiving information that you won't find in any other channel. Can I apply with different lenders?
A lot of individuals are not aware that they can shop around with different lenders and obtain different quotes for their interest rate. It is due to federal law that you actually have 30 days from the initial application that you provided to a lender to shop around, and it will not affect your credit score. If you wait more than 30 days, that will count as a separate inquiry to your credit score, and it could drop a few points, anywhere from 5 to 8 points, depending on your credit score range.
How do you determine the interest rate?
Once we have a loan application, we will run your interest rates and see what options are available to you. An interest rate is determined by several factors to include your credit score, your loan to value, which is based on how much down payment you will be putting down, and the loan product that you will be utilizing for your home purchase.
Should I pay off all my debts before applying for a loan?
In some cases, some clients may not want to submit a loan application because they feel they may want to pay off some debt first. It is very important to go ahead and submit an application with your loan officer because as your loan officer, we will be able to determine if you need to pay off an auto debt, credit card debt, or any other type of debt that you may have. In some cases, it is not necessary or it will not affect how much you qualify for or if you qualify for. So instead of holding off, go ahead and submit an application and we will then determine what steps you may need to take. I have seen some cases where a client will wait to apply and pay off all of their credit card debt, but they did not need to pay off this debt. Why? They had more than enough income to qualify for the amount that they wanted to, and instead they just waited, paid off debt, used some of their cash savings to pay off their credit card debt when it did not change the amount that they qualified for. So it is very important that you go ahead and apply, and then we'll create the plan that you need to take action on to buy your home.
Can you explain the loan process?
Once you have been pre-approved, the home shopping will begin. Once you find a property and are under contract, I will take your loan and update any documents that may be necessary, such as updated bank statements or updated pay stubs. Your loan will then move over to processing. A processor is an individual who will order the appraisal on the home, the title from the attorney, order verifications of employment, and a lot of little items that we need to get your loan over to underwriting. The underwriting department is a department that will review your entire financial profile and and will make a decision on your loan application. Once your loan is approved with conditions, your loan will come back to the processor, who will then gather these conditions or additional documents that the underwriter is asking for to get a clear to close. A condition is essentially a document or more information that an underwriter is requesting in order to provide an approval. Once we have received the clear to close, your loan will then go to the closing department to get a closing package to the attorney. We will get a closing disclosure, and then we will be able to go to the closing table.
What does a buy down mean?
During this market, you may be hearing a lot about buy downs. What a buy down is, you are buying down your interest rate for a predetermined amount for a certain amount of time. For example, a 2-1 buy down. For a 2-1 buy down for the first 2 years, your interest rate will be reduced for the first year by 2 points, the second year 1 point. For example, if your rate is 6.75% for the first year, your interest rate will be 4.75. For the second year, your interest rate on your payment will be 5.75, ultimately for the last year going back to the original amount of 6.75.
What does it mean to pay points?
During this market, you may also hear about paying points to reduce your interest rate. This is another way that will permanently reduce your interest rate when you are purchasing a home. For example, if you want to pay 1%, that is 1% of your loan amount. If you are buying a home for $400,000, you will be paying $4,000 to permanently reduce your interest rate. The amount that you are reducing your interest rate, or even the percentage amount that you are paying, will vary based on the market on that particular day. So it is very important that you speak to your lender to talk about your discount point options.
What does it mean to float your rate?
When you're going through the home lending process, once you get pre-approved, we will quote an interest rate to you. This does not guarantee the rate. As you know, interest rates vary based on the market. So once you actually receive a contract and we talk about locking your interest rate, we will determine if we will lock your rate at the moment, so it will stay the same through closing, or if we will do what's called float your rate and see what the rates do within the next couple of days and lock further on during the loan process. Now, one of the risks associated with floating your interest rate is that the market can change, the rates can increase, and now you will be tied to a higher interest rate.
What does it mean to lock your rate?
During the loan process, once you are under contract and you are going to lock your rate, if you lock it, that is the rate that you will be locked at for your home loan. One of the risks to that is that if interest rates drop when you are under contract and going through the loan process, you will no longer be able to change your interest rate. But one of the benefits is that if rates increase while you are going under contract and going through the loan process, your interest rate will remain as it was locked and it will no longer increase.
What expenses are included in closing costs?
When you are buying a home, you have closing costs associated with that home purchase. These closing costs include origination fees, attorney fees, recording fees with your county and state. Closing costs are generally paid for by you as a buyer, as that is a part of your home purchase. However, in some cases, sellers are willing to contribute to the closing costs of your home purchase.
What is included in a monthly mortgage payment?
As you are going through the loan process, we will discuss your monthly payment. The monthly payment consists of several items. These include your principal and interest, your homeowner's insurance, property taxes, and mortgage insurance, depending on the loan program. This makes up your entire monthly payment. Keep in mind that as you're shopping for homes, property taxes will vary by location, and it will even vary for properties that are the exact same purchase price, essentially ending up in a slightly different payment.
What are the different types of loans?
Once you apply, it is very important to know that there are various loan programs that you can use for your home purchase. One of the very most common loan programs is what's called an FHA loan. A FHA loan is very common because it has one of the lowest credit score requirements, all the way down to 580. It allows for your debt to go all the way up to 56% of your income, and it only requires a 3.5% down payment. This loan is very popular with first-time home buyers because of the low down payment of 3.5%. A first-time home buyer is an individual who has not been on title to a home within the last 3 years or never purchased a home. Another common loan program that is offered through lenders is a conventional loan. For first-time home buyers, you can buy with a conventional loan with as low as a 3% down payment. If you are already a homeowner, you can buy a home with a conventional loan with a 5% down payment as well. The differences between FHA and conventional are the following. With an FHA loan, you can go all the way down to a 580 credit score, and with a conventional loan, we can try to get you approved with a 6 620 and above, although it does prefer credit scores 680 and above. The FHA loan also has mortgage insurance that will remain for the life of the loan, whereas the conventional loan, you do have mortgage insurance that can be eliminated once your loan to value is 78%. Another loan program that can be offered to you is a VA loan. A VA loan is strictly for veterans, those who have served our country, or the spouses of those veterans. One of the first steps in obtaining a VA loan is having to be approved and verifying that you qualify for a VA loan. One of the best benefits of the VA loan is that it is a true 100% financing loan because it does not require a down payment from the veteran. One of the benefits of the VA loan is that it has very flexible terms, much like the FHA loan, where we are allowed to increase the debt to income as high as possible to get you qualified. A loan program that may be appealing to individuals who live in rural areas is what's called a USDA loan. One of the key factors with the USDA loan is that the home must qualify for USDA and be in an eligible area. If the home is eligible, you may then be eligible for 100% financing because the house does not require a down payment, and you may potentially be able to finance all of your closing costs as well. A loan program that is very appealing to home investors is what's called a DSCR loan. One of the benefits of using a DSCR loan for your investment purchase is that you do not have to show income documents. With the DSCR loan, we just verify your credit is 680 and above. We will then verify that you have a 20% down payment of the purchase of the home, or depending on your credit score, that down payment can be a little bit higher. We will then ensure that the property meets the DSCR calculation requirements. Please verify with your lender what those requirements are, as they can vary from loan program to loan program. An alternative loan program that we offer if you are not able to qualify using your tax returns is a bank statement loan. With a bank statement loan, we will request your 12 months most recent bank statements, whether they are business or personal, and we will then run an analysis to determine what income we can use to get you qualified for your home purchase. The minimum down payment will be 10%, but it could increase based on your credit score. With this alternate bank statement loan program, your interest rate and your down payment will be higher than a traditional loan program.
Can I get a loan if I'm relocating to Georgia?
Can you get a loan if you're relocating to Georgia? The answer is yes. If you're relocating to Georgia and you have a job offer in the state of Georgia, you are able to buy a primary residence. We will need to verify the terms of this offer and ensure that we can use it to get you qualified for a primary home. If you're relocating to Georgia and are self-employed, you will typically have to wait at least 1 year to file your taxes for us to be able to use your self-employed income within the same industry. If you change industries, we will need to see 2 years of self-employed income to get you qualified for your home. If you're relocating to Georgia and you are self-employed but are now obtaining a W-2 employment, depending on this employer, we can possibly get you qualified immediately if you are salary or working full-time 40 hours.
Are there any loan programs giving free money to help me buy a home?
Currently, during the filming of this video, we are offering a $7,000 grant that is based off where the client lives. The first step in seeing if you are eligible for this grant is determining where you live, and if you live in an eligible area, we will then qualify you for a conventional loan. The client must qualify for a conventional loan to get the grant. What is offered in the grant? $7,000 at no cost to you, a $500 appraisal credit, and also a free home warranty for up to a year.
Now, those are the most common questions that buyers have regarding financing when purchasing a home. I've placed all of Natalie's contact information down below in the video description. Now, if you're that type of person that likes to learn from other people's mistakes and not make the same mistake, make sure to watch this video right here. It's going to help you out a lot. Thanks so much for watching, and I'll see you in the next video.